Hi there, I'm Edward Khalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. If you've been following my tech series, you know the drill. And if you're new here, welcome to the club. Today, we're going to break down Apple stock using the 5 key factors to form an opinion on whether it is undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Apple is the world's most valuable company with a market capitalization of $3.6 trillion. With over 1.5 billion devices ranging from iPhones to MacBooks, Apple is more than just a brand. It's an entire ecosystem. But will they keep this position as they push themselves into new markets such as AI and virtual reality headsets? Before we dive into Apple, don't forget to give the like button a little love, and if you're new here, subscribe to my channel so you never miss out on any future content. Now let's break Apple down into our 5 key factors. For the first factor, we look for companies with high returns on capital deployed, preferably a return on invested capital and return on equity ratio that is higher than 15%. As this gives a strong indication of financial efficiency and future profitability. Apple impresses with a 5-year average return on invested capital of 32.7% and return on equity ratio of 146.1%. However, the return on invested capital has been decreasing in the past 4 years from 35.6% to 30.6%, which shows reduced profitability on their investments. I think the return on invested capital is a better metric to focus on here, as Apple's equity is skewed compared to its net income. For example, in 2024, Apple generated $93.7 billion in net income, but its total equity was only $57 billion. Now you might wonder why that equity is so low compared to income. The answer lies in Apple's massive stock buybacks, which totaled $100.4 billion in 2024. Basically, Apple's net income boosts its equity, but then it's reduced again as the company buys back stock to return value to shareholders. Now this raises the question why Apple is not reinvesting this money back into the company. Are there not enough investment opportunities? And how sustainable will these buybacks be when growth continues to slow down? Next to that, we look for companies that are able to grow earnings. Apple's revenue grew at a 9.9% compounded annual growth rate and earnings per share of 17.9% over the past 5 years, reaching $6.1 for fiscal year 2024. But here's the catch. Earnings have been flat the last 4 years if we leave out 2022 earnings. The constant 6.1 earnings per share for the last 3 years is mainly due to share buybacks, which reduce the number of shares outstanding. Without that, the earnings per share would have dropped alongside net income, so not as impressive as it seems. Will Tim Cook, the CEO of Apple, be able to turn things around? Or will Apple be functioning more as a cash cow to investors? Based on Apple's capital expenditures, this does not appear to be the case, as capital expenditures have even decreased from 2023 to 2024. In our previous episodes, we saw that other tech giants such as Alphabet, Microsoft, and Meta are actually increasing their capital expenditures based on future demand expectations. In Apple's latest earnings call, Tim Cook confidently declared that Apple is ready to take on generative AI, trying to squash the idea that Apple is lagging behind. Sure, Apple has the chips for an AI-powered smartphone, but current phones can't handle the memory demand. Experts predict that AI phones could make up 40% of sales by 2027, and Google is leading the charge by integrating AI into Android. The challenge for Apple would be why users would need these new AI features and, more importantly, on their devices. One easy win for Apple would be to supercharge Siri with generative AI. Plus, Apple's privacy-first approach could be a big selling point. Users get AI without worrying their data is being harvested. However, to avoid building massive AI data centers, Apple might need to partner up. Perhaps with OpenAI or Google, but that could be pricey, especially since Google already has its own AI models ready to plug into Android. Even if Apple nails the AI smartphone, the big question is, will it be enough to boost their future earnings in a meaningful way? For the third factor, we look at healthy financials. Apple has a total debt of $119 billion and $65 billion in cash and short-term investments, which is acceptable as Apple also earned almost $94 billion in net income for 2024 and can easily pay down its debt. Apple's debt has been decreasing since 2022 from 132.5 billion to 119.1 billion in 2024. Cash and short-term investments have been increasing from 48.3 billion to 65.2 billion over the same time period. This confirms Apple's healthy cash flow generating power. Now for the fourth factor, is Apple undervalued? Apple's PE ratio is almost 38, which is higher than Microsoft, Meta and Alphabet. Basically, the market is saying, we expect big things, but revenues have been slowing down recently. So is Apple overpriced compared to the broader market, where the S&P 500 PE ratio is around 30? Yep, looks like it. Now, according to super investor Peter Lynch, if earnings growth is less than the PE ratio, it's a red flag. Apple's earning growth rate is 18%, which is way below that 38 PE ratio. The gross profit generated from products such as iPhones, MacBooks and wearables is roughly 1/3 of total products revenues. When we compare this to services revenue, which comes mainly from iCloud and the Apple Store, the gross profit margins are much higher. Apple's been pushing hard to grow its services revenue, but with product sales dropping, that's becoming trickier. Fewer devices sold means fewer chances to cross-sell services. So unless Apple can turn this product slump around, future profits might be in trouble. A strong moat is key for future growth. It helps protect long-term profits and market share from competition. Apple's moat is rock solid, thanks to its loyal customer base and ecosystem lock-in. Once you buy into Apple, you're in for life, because everything just works together. Apple's strategy is to perfect, not pioneer, refining existing ideas for the best user experience. Plus, with its premium brand comes premium pricing power, and customers are happy to pay for that shiny Apple experience. Services like iCloud and the App Store give Apple a high-margin, recurring revenue stream, making them less dependent on product cycles. But hold your horses, Apple's moat isn't invincible. Samsung and Google are coming for it. Google's AI push and Samsung's high-end hardware could nibble at Apple's dominance, especially in Asia. In emerging markets, Apple's premium prices face some serious competition from cheaper brands. And let's not forget, Apple can't just keep on relying on the iPhone forever. If they don't deliver something truly revolutionary soon, they might end up being the next Nokia. Oh, and with all the regulatory heat from the European Union on its App Store, Apple could face some tough changes that could hit their services revenue. Now, before we conclude on Apple, you may have spotted in the charts that I've used in my video that these were created with the help of FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. To wrap up, in my view, Apple is overvalued based on the 5 key factors. Apple has relatively high returns on capital, but that is decreasing in the past 4 years. Earnings per share are flat at $6.1 per share in the past 3 years. And whilst share buybacks help, they can't hide the fact that net income has decreased from $99.8 billion to $93.7 billion in the same time period. Services are the growth lever, but with product sales decreasing, that becomes trickier for the future. Unless the AI iPhone saves the day. With a PE ratio of 38 compared to roughly 30 for the market, Apple's stock seems overvalued to me, especially since its earnings growth is lagging. Apple's strong moat and loyal fans are great, but they can't keep on relying on the iPhone forever. They need something big to turn this trend around. Let me know in the comments below what you think. Overvalued or just getting started? Or maybe you want me to dive into another company. Thank you for watching and see you next time.